Time is the most important yet most misunderstood dimension in investing. You need to absolutely nail this if you want to make big money from markets. However, note that time takes many forms and expressions when it relates to investing, so brace yourself for this video. 3 years ago, I wrote this piece on Philoinvestor on the dimension of time in financial markets. It was kind of philosophical, so I will break it down for you. I started by saying that we will distinguish the dimension of time from financial markets and discuss its power and influence in the financial arena. This part here basically talks about DCF, discounted cash flow, which is a typical time and discounting. But then I go on to talk about the concept of time and discounting as it relates to valuation in markets. Why do I say this is fragile and can break down? Because there is a thing called time preference in markets, and it can take many forms. And as it changes, it acts as gravity or rocket fuel for asset prices. So let me explain. When time preference is low, then investors discount 10 years forward. They don't really need high returns to exchange their cash for securities. They are in effect looking very far out in time for a return. Basically, this is what's happening now in financial markets, specifically big tech, Mag 7, all that. However, the opposite of that is when investors require a high time frame preference to exchange their cash for assets. So from 10 years forward, now they're discounting 18 months or 12 months. And there is a third year where markets completely break down. Think global financial crisis, 08, 09. And that is a step change in how markets behave. Complete breakdown. So they discount almost nothing. They don't look into the future at all, or almost at all. Okay? So this is the dimension of time aspect. Let's move on to time arbitrage. And I have a quote for you. The longer you can extend your time horizon, the less competitive the game becomes, because most of the world is engaged over a very short time frame. So I decided to draw a little chart for you so you can understand this. The x-axis is time. The y-axis is competition for value, for profit, for a good deal. In the short term, competition is high. In the long term, competition is low. So if you're an investor thinking of the short term, trying to make money now, everybody's trying to do that. However, if you practice time arbitrage and you think of the long term, competition is low. This is where the big bucks can be made. And let me explain it better. Same chart. This is time. This is competition. This is how it behaves. If you invest here, your returns are abysmal. If you invest here, they are average. But if you invest here, they are great. If you ask me, those investing in passive securities and instruments right about now are getting this. But that's a different conversation. So, what's the difference between investing here and here? Let's calculate the difference. 5% for 30 years, 10% for 30 years, and 20% compounded annual growth rate for 20 years. The difference is staggering. 5% for 30 years gets you approximately a 4.3x. Wow, that's nothing. 10% for 30 years gets you 17.5x. But 20% for 30 years, which is double that, gets you 237x. So time expresses itself in many forms, and compounding and compounded growth rates is just one of them. To wrap it all up, I think you need to practice time arbitrage. That is, to have a constant mindset of thinking longer term when you look into companies. What's something special that a company, a business could have that could allow it to earn great returns for a long time that the market is missing? And look to buy that business when time is very cheap. So enough on time. I think I've confused you enough. We will talk much more about time in the Zero to Hero Investing course. Check it out here. And obviously, look to the show notes for more information on this concept.